What's going on, YouTube fam? This is the Wealth Investing Network. We do this for the win. You're getting a sneak peek into my stock portfolio and a sneak peek into my research on stocks. Today, we're talking about two tech companies that are very popular with investors right now. Palantir Technologies, because always, and C3.ai, because they recently reported earnings. This is their Q4 report because their fiscal year ends on April 30th, but that's not the important part. The important part is that they grew their revenue 38% year over year. And I'm going to get into the weeds of this company. I'm going to quickly overview Palantir, but we just talked about them in a video recently. So be sure to click on that video if you need to catch up because I want to move quickly here. Now, after C3.ai's earnings report, we saw a mixed bag in the news. After reporting that they grew almost 40% year over year, their forecast did indicate that they're going to continue growing, but it's going to be a decline in growth of 25% or less. And management did not provide a specific reason for that, which leads to uncertainty and FUD. Investors don't like that. When you look at the stock chart, they dip towards all-time lows, but now they're actually up on the week. And when we zoom out in the past year, the company's down more than 70%. And when you look at them since their IPO, the action in the last week is really just a blip. And this is where I have to remind investors and remind myself too, that the stock can be very different from the actual company and how the company is performing. This company's been growing their revenue for a while. They've been reporting pretty decent results, but you have to think about valuations for stocks. You have to think about the market capitalization because the market cap is a function of the price of the shares and the number of shares outstanding. It's just that simple. It's not directly tied to any metrics like their revenue. I like to say it's more about how people feel about the company. It's a supply and demand thing. So shortly after this company became public, their market cap went upwards of $17 billion. And now they're sitting right around $2 billion because over time, excitement went down, the demand side went down, so their market cap went down. The metric that I like to use to look at a lot of tech companies is the price to sales ratio because this is actually tied to their revenue. The PS ratio is a function of their market cap and their revenue. So you can see as their market cap went down, their PS ratio also went down, even though their revenue was growing. And so when the PS ratio is lower, the stock starts to look more and more attractive. The average price to sales ratio for tech companies is in the single digits. But I'm not saying anyone should go out and buy C3.ai stock right now. One, because I'm not a financial advisor and this is not financial advice. And two, because there's some other concerning things. Now, we talked about how the stock price started so high, and you might think that the stock soaring after the IPO is a really good thing, but it could have been better for the company. Their IPO was priced at $42 a share, but shortly after they shot above $160, and that means they left money on the table. They did raise $651 million. They ended up with almost $1 billion in cash and short-term investments. But they probably could have raised $2 billion. And more cash would mean more flexibility for them to make acquisitions, invest back in their business, do all kinds of things. We're mostly going to focus on the stock, but I'll get into a little bit about what they do. C3.ai has software suites that they can provide to large commercial customers and governments as well. Essentially, business is booming for C3.ai. They're able to grow their customers. As an example, maybe a customer that you wouldn't expect. Oil giant Shell monitors 10,000 devices using C3.ai's machine learning models, which currently make 1.3 trillion predictions per month. This can prevent costly equipment failures and reduce greenhouse gas emissions. They also have a deal with the U.S. Department of Defense that could mean $500 million over the next 5 years. Even Microsoft and Google are getting in on this. I like how in their presentation, they kind of shout out all of their competitors like the AWSs, the Azures, the Snowflakes, the Palantirs. They say, okay, these are all our competitors and these are all our partners. It's basically the same. We work with all of these companies because likely we're not the only software suite that our clients are using. So we all have to work together. Now, getting more into the weeds about their financials, let's look at the total revenue. It went from 183 million to almost 253 million. But this is where a lot of companies get tripped up. Their total operating expenses. It's very hard to keep expenses down. Now, your R&D expenses, your G&A, I'm not too concerned about that. You're investing back into your business to make your products better. Okay, cool. The one that gets me is the sales and marketing. They went from about 97 million to over 173 million. And it seems like one of the reasons they have to do that is because there's so much competition out there. And they have to explain to their potential clients, okay, here's exactly what we do and how we're different from all these others. So they're spending a lot more than they're making. leading to a pretty huge net loss. And they're actually not even factoring in everything. Stock-based compensation doesn't necessarily count on the income statement, but you can find it on the cash flow statement. You have to pay your workers and your executives one way or another. And if you're paying them in stock, it could have an effect on the stock price. Remember, when you have shares of stock, shares of the company, that's your piece of the pie. If they're handing out shares like candy, everyone's piece of the pie is getting smaller and smaller and smaller. And you also want to see if they can prove what they're saying about their path to profitability. They're saying, yeah, our cost of revenue is going to stay about the same, but what we're going to reduce is our marketing spend and our R&D. Well, we just looked at their financials. If they really can do the opposite of what they've been doing this whole time, that's great. Fantastic. Moving on. Here is an insight that is positive for the stock. The market has essentially dogged this stock, bringing their price to book ratio very, very low. Okay, so what is the book value? Essentially, it's the amount of money that would be paid to shareholders if the company was liquidated and paid off all its liabilities. If they went bankrupt, which they're really not at risk of doing, this is a company that has almost $1 billion in cash and short-term investments. So a price to book ratio that's under 1 is considered a potentially undervalued stock. So as these two numbers get lower, that's kind of interesting to me. Turning to Palantir, when we compare some of those metrics, the share price is a little lower, but the valuation is a little higher. They launched onto the stock market at about $9, and that's about where they're trading right now. Now, Palantir did not do a traditional IPO. They did a direct listing, so they didn't really raise any money, but they still have about $2.5 billion of cash on their balance sheet. Now, what does Palantir do? Well, they have some software platforms as well. Their software can help make informed decisions. Here's an example. The U.S. Army uses Gotham to collect intel from various government agencies, also pair that with data from local resources, and that helps them plan missions. Now, Palantir software received a lot of notoriety for its role in finding Osama bin Laden. Around that time, they were mainly working with governments, but they really began to expand their commercial side as people started to understand what their technology could do. Now, I'm not going to get too much into the weeds. You could go to their website and you could fall in love with their technology and all the cool things that they could do and how they probably stand out. But please remember that there is a very competitive field out there. And if businesses think that there's another software out there that can do something similar for a cheaper price, well, it's about dollars and cents at the end of the day. Speaking of which, while Palantir has really nice revenue growth, in terms of their government side, it's declining. With the way it's trending, their government side is going to be in the single digits in terms of growth. Even if their commercial side of their business is booming, that kind of bad news could lead to a real hit in their stock price. But they have tried to assure investors that their total revenue is going to be at about 30% in perpetuity. I guess until they say otherwise. Because previously Palantir said that their Gotham platform could become the default operating system for data across the US government. Well, at least one agency plans to replace Gotham with an internally developed system called Raven. And it would be bad for Palantir if other agencies decided to create their own systems as well. Even though Palantir is a company that is cash flowing, which is more than I could say for C3.ai, they're still spending more than they're making, which I don't like to see. And they're still giving out massive amounts of stock-based compensation. And you might say, well, they have to pay their employees in stock to be competitive with the Googles and Amazons of the world. But Google and Amazon stock is going up for one, and Google and Amazon are doing share buybacks, which actually increases the value of everyone's shares. And here's an example of how your slice of the pie is getting smaller if you're a Palantir shareholder. Their revenue since their IPO has gone up and up. I mean, they've almost doubled. But when you put that on a per share basis, right, when you take that and put it over the amount of shares of the company, well, the shares of the company have gone up so much that their revenue per share is essentially flat or really even negative. So what does all that revenue growth mean if you're essentially back where you started or a little bit worse? Now, normally I would take this spreadsheet I do and go one by one, but I don't think we really need to do that because we've talked about a lot of these things already. At the time of recording this video, Palantir is trading at a slightly higher price to sales ratio than C3.ai. You can tell that it's the much bigger company bringing in a lot more revenue. C3.ai has the higher revenue growth, but in terms of their projected outlook, we'll see. In terms of net income margin, Palantir is closer to profitability. And in terms of their current ratio, Palantir has a little bit of an edge there as well. They have $2.5 billion in cash versus C3.ai, who has a little bit less, but still impressive. Things to keep an eye out for on both companies would be the shares outstanding. Do you see these continue to increase? For C3.ai, are they being conservative in terms of their forecast? Is Palantir not being conservative enough? Again, both have seen huge dips in their share price. I'm a long-term investor. I'm not really for trying to time a bottom in these stocks. Everyone really has to do their own research and come up with their own process of how you buy stocks and what valuation looks good to you. And if you've done that, tell me about it in the comments. Also, don't forget to hit that like and subscribe because it helps us grow and helps me provide better content for you. That's what I call a win-win, and we like that here at the Wealth Investing Network. All right, I've got to go set up a futon. See you in the next video.